All right, guys. Happy Friday. The last Friday of May. Today, we are the last word still, and we are still a Chrisman commentary show. Every Friday here at 1 o'clock Eastern, we are bringing you the news of the week. You've got KP, Christy, and BV in the house today. Courtney is off doing Courtney things. So, guys, how you doing?
I'm super jealous. Courtney's having fun, I bet.
Probably.
I think that your life is pretty much just made up of fun.
You know, I love what I do. I love this business. I love people. I love the industry. And, you know, it's just, yeah, I mean, I don't feel like I'm working. I mean, not gonna lie, like, there's definitely some times where it's a grind, but, and I apologize for being completely scrubbed out. So for those that have kids, you understand like how end of school year activities this week has been insane. And so our 6th grader is on like student government. They had flag deck, and it was like an hour and 15 minutes. So I went there like scrubbed out, thinking, oh yeah, we'll be there giving awards and tell like, you know, just anyway.
It's that time of year. All the end of school activities. I just came off a call, and the guy I was on has got like, you know, 5-year-old, 7-year-old, 9-year-old. I'm 22 years removed from any of that. So
same.
So all 4 of our kids play soccer, and my joke is that, you know, we're balls deep in soccer every weekend. So it's yeah, it's a lot of fun.
Yeah. All right. Let's unless we want to cover any other you know, personal stuff. I know you guys are both heading to Chairman's.
Oh yeah, you're going, Christy? Let's go.
I don't know what about you. I'm here. I'm in Georgia. I'm at my mom's.
Oh, nice.
Yeah.
Just got a head start on it.
Yeah, NBA Chairman's is kind of like the last. Yeah, it's like the last like trade show of the year, right? I mean, there's some other ones, you know, like, you know, Mortgage Mastermind and stuff, but on the NBA circuit, you know, this is like, hey, let's regroup. Spring purchase season is coming to an end. What do we learn? What do we need to talk about? What do we need to think about going into next year? And then, you know, then all the fall shows start to kick up, you know, in August. You know, we've got California NBA has the Western Secondary in August at Terranea. And, you know, and then it's just go, like all the way through September and mid-October for annual. And then, you know, take a deep breath. So it just never ends on the conference and trade show circuit, but you do catch a little break in the summer here for about 2 months.
2 months, yeah. And then I know KP, I think you're going to go from Chairman's to Atlanta for the EPM tag event, right?
Yeah, Eddie is super cool. You know, he's a great owner. He's very collaborative. You know, it's like the spirit of this commentary that we do here. And so he's yeah, he invited some of us to go up there, and we're on a panel. We got a collaborative, you know, thought leadership panel. He rents out EPM and team rent out the Mercedes-Benz Dome in Atlanta. Like, you know, they're all on the floor. It's a pretty cool event. So I think David Portnoy is speaking, and Kevin Hart and some other ones. So yeah, going straight from Sea Island, Georgia to Atlanta for a couple of days, and then back home Friday for the last day of school, and then hunker down and get peppered with kids 24/7.
It'll be fun.
I'm going to lock down my travel, but I'll probably see you there at the tag event as well.
Okay, cool. Let's do it.
Yeah.
And I'll see Christy in Georgia.
And you guys will see each other.
You come in tomorrow, or you come in Sunday?
I get in late tomorrow night.
See you after dinner.
At the bar.
Well, you know me. I might be in bed. Like I go to bed early.
Yeah, I know.
So the entire mortgage industry is completely bored with our opening 5-minute.
They are.
Well, you know what? I think it is interesting to know, like, you know, because, you know, just to kind of help pivot into, you know, part of why I started doing like my LinkedIn video is because there aren't a lot of people that travel.
Yeah.
And they want to know, you know, and they certainly don't travel as much as, you know, like, you know, Rob Chrisman does or Bob Brooksmith. And so they want to know, like, they can't be at every show. And so some of it's like, well, what are you guys learning? You know, what do you get out of these shows? And we've talked about trade shows a lot. So I think there's some interest of people like, well, what, I'm not going to Sea Island, Georgia, because, not my bag, but what did you learn? So maybe we'll have some takeaways next Friday.
Oh, I'm sure you will, for sure.
I'm sure we will have takeaways next Friday. This week, though, it feels like it's already summer and that the industry has started to slow down. But there are. My mom's an English teacher, so I'm going to be really thoughtful of my grammar today. Just, I don't want her to throw little wads of paper at me and be like, "Stop it." Not that she would ever do that. But there's a lot of data that's coming out right now. And I was reading with much intrigue because you care a lot about the city that you live in. And when it pops up, it just kind of things land a little different. Talking about the number of sellers versus the number of buyers and where inventory is. And then the prognostications about does that mean for the marketplace? I mean, everybody got out their little magic 8-ball and said, here's what we think it means. So did you guys read that data? What do you think?
I'll just say this. Volume is up, purchases are up, loan applications are up, business is up. So let's just start right there, right? So it is a better year to date than last year.
Absolutely.
So when? Yes, there's more inventory. Yes, some markets have some outright price declines, and that's because you start looking at the median price and the higher end stuff has kind of come down, but there's still home price appreciation. And even by the most conservative indices that are out there. And, we all know the deal. Like all it takes is lower rates and here comes a rush of all the demand, Now, when will lower rates come? I don't know. But I still think, we're in a decent, lower rates now is defined as 6.4% and under.
Right.
And I think that's what people need to kind of recalibrate, because I think a lot of people are talking about when the next refi boomlet's coming. At 6.4%, just in the last week of March and in early April after Liberation Day, kerfuffle, this industry exploded. Exploded on lock volume for both refi and purchase business. And so when we talk about lower rates, it's pretty much 6.4% and under. That was the line that I saw that really got people off the shelf, because you think the last 3 years, you've got people who bought houses in the 7s, mid 7s, even high 6s. Any loan amounts are so much larger now that even a 0.5% reduction in rate is a pretty significant monthly savings. Plus, you get to skip a payment or two on a refi. So lower rates to me is now defined anything under 6.4%.
And it's interesting that it's taken us years, literally years, to get to that mindset, though, right? Because I can recall as recent as 6 months ago, 5.5 was kind of still that, that's what it's going to take to move the needle. And I think you're right, KP. It's the longer this goes on, the bar just gets moved a little bit more. And add on to that, consumer credit and consumer debt has gone up. So you've got other factors that could make a smaller rate change more impactful because of the dollars. And then to your point, that what goes along with a refi typically is the ability. I was coached never to say skip a payment, to finance a payment into your refinance.
Yeah, you definitely.
Christy, did we answer your question, Christy? I don't know. I was trying to think if that was the data point you were looking for.
Yeah, well, it's an interesting conversation, and one of the things that the data said was that Austin was in this place where they had more listings, like number 3 on the list, I think, and that there are way far more listings compared to home purchasers. And then there was an analysis or some commentary that some folks put out on LinkedIn that said, well, how do you know that's the amount of purchasers that you have? We have been in a market where prior to COVID, this is kind of how we did that analysis and how we could tell. And today that analysis really doesn't hold water. And so you're using an outdated model to try to show that this is what's going to happen and tell us this is what the prediction is. And that's kind of where I fall in this, is that it is, to your point, maybe a condo market in Miami looks a little different than what could be happening in Austin, Texas, or in Detroit, Michigan. The markets have those variations and have always had those variations, but I don't know that our models are telling us today the same things that they told us pre-COVID. And I don't think we've tweaked them enough in many cases to really understand and be able to predict. It's great to talk about the data points, and we need to do that. We need to continue asking our very smart data scientists and data analysts that are on our teams and that are out there in the world to look at these things and, hey, how do we get to a point where we can go back to predicting things with a little more certainty? Because it's always good to get your forecasts right. The board likes it. The investors of your company like it. And if you're the owner of a company, it's really pretty darn good to have that as well. So we've got to continue to tweak it. I'm not the doom and gloom. I don't think that the market is going to take this big nosedive, regardless of whether the GSEs get released from conservatorship, next week or a year from now or 2 years from now. I think that the people are resilient. The markets are resilient. People still want to own a home. It feels different to own a home than it does to rent. It makes you part of the community, and it just changes those things. So I think the data is interesting to have a conversation. So you went exactly where I thought you would go, with an interesting conversation.
Yeah, I would add that, you bring up a couple, markets. Austin, I lived there for 9 years, only 4 in college, just for the record. And I started in the industry as an account executive at First Magnus in 2001. And Austin is always, it's a counterculture city, especially compared to the rest of Texas, which is mostly conservative. But it's also been kind of a counter bellwether market when it comes to real estate prices. They're always one of the first ones to kind of drop when everyone else is kind of going up. And so you kind of saw that recently in some of the data in the last 6 to 9 months there. And so if we see a slowdown, in broader markets, it's weird. Austin kind of tends to tick up. It's just always been this counter market. But then you brought up Miami condos. Since the Champlain Towers crashed, in Golden Beach in Miami, the appetite by the GSEs for condos obviously has waned, and insurance is hard to get. The deductible for insurance is high. HOAs are strapped because people aren't making, their payments. And in addition, to having lacks in the budget plus insurance going up, it's harder to get Fannie Freddie liquidity into condos. And so, and then plus there's all this data. You see great data like Totality puts out. They show these maps of like where the water's going to be. Like in 2035, like Miami Beach is underwater, right? So, if these loans are like a 30-year proposition, I mean, who wants the condos, right? So then you start to pivot to non-QM. So anyway, I'll just sit back and say that lower rates cures everything.
I would agree that lower rates are ideal in a place that we want to go. And you hear the current administration talking about that. And every administration really talks about affordability and how do we best serve Americans. And it's up to us to do some of these things. One of the things, and Kevin, maybe you hear, in your conversations with LOs, as I talk to LOs across the country, they're like, hey, we're looking for something that is different than the standard. There's this desire to think about the business in a different way. And what are you hearing when you talk to folks on the street as they talk to consumers and to our borrowers?
Well, I mean, Brian, if you want to take it, I'll pivot off of you. You do way more work.
Yeah.
In the streets.
Answer Dusty's question.
Oh yeah, Champlain Towers, CHAMPLAIN, Champlain Towers in Miami Beach. I think it was about 4 years ago. I don't know the exact date.
Thanks,
but there it is, Surfside. Boom, done. So Surfside is like it's like in between Miami and Fort Lauderdale. It's a little closer to Miami. I used to go to that beach, literally when I lived there. It's a shame. Anyway.
So, Christy, what I was going to say was I'm now 4 weeks away from being 6 years removed from being, thinking about board meetings and forecasts and kind of macro economics, if you will, as far as the business goes. And now I feel like I'm like this hyper local guy because I square off literally every day with either groups or one-on-one loan officers everywhere across the country. And so it's fascinating to have conversations and hear conversations market to market, state to state with, usually the people I'm talking to are, the top third of the production curve in terms of loan officers, not for any other reason than that cohort of loan officers tends to be more forward thinking versus the bottom third or 2/3 are kind of, I don't know. In some ways they can't get out of their own way, but that's another show, another story. A good example, Jeremy Forcier with Cross Country was on with Dave Savage on Tuesday. Dave does this 10X Tuesday show on his Mortgage Coach YouTube channel, which is up to 25,000 plus subscribers, which is amazing. I literally block my calendar every Tuesday for that, 45-minute to an hour conversation. And what Jeremy was describing was, and he's a top 1% producer, right? He also has a team. His business shifted like almost inside of 60 days, where the beginning of the year, first 2 months, January, February, first part of March, he was talking about the biggest segment of business that he was seeing was coming from what he described as first-time sellers. So this would have been people in his database that he'd helped buy their first home 2, 3, 4, 5, 6 years ago, who were now first-time sellers, right? And so Jeremy's not accidentally in the top 1%. So for him to have conversations with first-time sellers from his database tells you he's doing things right. He's staying connected and meaningful to his database. But literally in a window of, I think it was less than a month and a half, he said that it shifted, his pipeline shifted from, being a third plus these first-time home sellers to back to being like 45, 50% first-time home buyers. And so it just tells you that there's a lot of, there's fickleness even in local markets, right? And there's no better way to see that than to talk to the top teams, the top producers. And KP, I'm sure if you went across your, top 20, 25% of your loan originators, you'd have similar stories in their markets where they literally see shifts happen that quickly inside the market.
Yeah. And what I'll say is I've seen, obviously Dave Savage is a neighbor and a friend, and I've seen him and Jeremy Forcier countless times on those channels. I love the first time home seller. We just had our president's cabinet in Tulum, Mexico. So I had a chance to break bread with all of our top producers in all three of our channels. And, and of course I'm tied in, I know what they're doing. But what I would say is that pivot you saw was because rates went lower very quickly. And so, and we talked about it a couple shows ago, there's this battle we talk about all the time here about servicers versus originators. The originators are winning this year. I've been saying about 75% of the business this year is purchase business. There's a study that came out from Stratmore that said 81% of business in Q1 was purchase. Mm-hmm. So the servicers don't really win at that. They just don't. I mean, they could try, but they just don't. And originators in the community win at that. And so they have the most to gain. And when rates, when literally the 10-year treasury went from like 450 down to 386, that brings affordability for first-time home buyers back in the fold. And they're prepped, great LOs and originators at the top level, have a bunch of pre-qualified borrowers just waiting to get in. And some of them, I remember when, 3 years ago when rates shot up all the way through this time in 22. I don't know if people remember, February of 22 was the lowest rates in history. And it shot up all the way through June. And there were these stats that would come out from Black Knight. Now it's ICE Mortgage Technology. They own this, the data with Andy Walden and them. That when the rates went from 7 to 8%, 5 million borrowers were priced out of affordability.
Yep.
Right.
Okay. And that was 3 years ago. And we'd have nothing but home price appreciation since then. And so, and insurance has gone up and taxes have gone up. So that hard pivot you said, Brian, is, again, rates went down, business goes up.
Yeah.
Shocker.
Now, the only way that somebody like Jeremy and any other, loan officer or team of loan officers can win and take advantage of that is if they've got systems and processes in place and continue to add value. It's, it's one thing to do a pre-qual and pre-approval, but, a week later, if you're not, top of mind, or acting like a total expert, I'll give everybody love in this equation. If you're not doing things to continue to show value, then it might be 90 days later when they're ready to buy because rates came down. You need to stay in front of your pipeline. And, KP talking about the servicers not winning in this purchase environment. I think we all need to recognize that they're geared up to win when the market gives us, some of these refi boomlets, right? And again, if you're an originator who's not mindful of staying relevant and impactful to your database, you will lose. And what I don't want to hear is the servicer, they stole my customer. Well, no, you didn't do enough to earn the right to be thought of when there was a opportunity to refinance.
But really, I think you also have to be in front of your purchasers. Your database is the thing that really is of value to you as an originator. It was to me when I originated for many, many, many years and continued to actually bring me deals when I no longer marketed and was an originator, when it was not my main source of income and allowed me to refer deals to people on my team for a long time. But you've got to continue to feed that. It's kind of like that sourdough starter thing that you've got in the corner of your kitchen. If you don't feed it, it dies. You've got to, I don't know if anybody's a bread maker over here, but I love fresh homemade bread, and sourdough is my favorite. But I kill when I travel, I forget to ask somebody to go feed the little starter thing, and then it dies and I have to start over. And your database is like that. You've got to continuously put new names in it. And you've got to continuously, Brian, to your point, add value. Like, how are you educating folks on what's going on in the market? How are you staying top of mind for them? Not to call on anybody in particular, but how are you staying front and center with those folks and really adding the value? Are you looking at the open rate of the emails that you're sending out? Are you communicating in text? I know we've talked about in previous shows. How are you using video to be with folks? You've got to be eyeball to eyeball. You've got to create that relationship so that they want to reach out to you, because you can't know every change that's happening in their life. And you can't know when something's going to prompt them to do something. Like, as an example, my son got engaged yesterday. And that is that's one of the D's, right? Diamonds. And in his case, he already owns a home. But if he didn't, that could be something that, regardless of rate, prompted you to go and purchase a home. Well, I'm not going to know that somebody in my database decided to do that.
I'm not trying to be like a bearer of bad news, but there's a saying that a son is a son until he finds a wife. A daughter is a daughter for life. So you better cherish these last few moments, because he's
Whoa.
We've got 3 daughters and a son, and so I have another saying about it's a little bit more crass, so we'll just keep that one with the bars. But
I'll see you tomorrow. You can share it then, and Aaron will be with me. So
Oh, sweet, good. We congrats on setting the diamonds. So yeah, they're probably gonna, when you get a diamond on, and you get married, it's like, all right, that's the thing about, all like, pending sales are down, and home price appreciation is going up, but it's slowing. News is weird, because you can find the good and the bad literally in almost every report. But at the end of the day, deployment, diamonds, diapers, divorce, debt, downsizing, and death, like it still happens, and people need to move, and they need a roof over their head. Shelter is, in Maslow's hierarchy of needs, it's pretty close to the top, right? So I think it's what, air, water, food, shelter, and then love. I think love should go above shelter, but people need a home, and they need to find a way to get in there. And so that never ends, no matter what rates are at, no matter what pending home sales data report says, and so congrats to your son.
Thank you.
Yes, that's pretty cool.
I think that what we've highlighted here, and this kind of comes back over and over again, is it doesn't matter what the data says. You can interpret the data in a lot of different ways. It's good to know it. It's good to share it. It's good to be that that person who is educating folks that are in your circle, but you've got to constantly be growing your circle, constantly. And you have to continue to add value to the people that are in that circle, regardless of what's going on. And good originators, the top originators, and by the way, those that are new to the business who aren't jaded yet by whatever has happened. If you continue to get out and do the things, your business will grow and you will continue to win regardless of market cycle.
Right, good comment there by Sean that you highlighted. Yeah, I would say, it depends, right? Because every servicer has a different appetite. Some of them take out debt to fill up their servicing portfolio. Some of them are using their own cash. I would contend that a 3% coupon has a lot of equity because it's a little bit older vintage. And so if you're a bank that does a lot of equity lending and you do HELOCs or second loans or HE loans, you probably prefer that, plus the stickiness of a 3% loan never paying. Now, if you're at a servicing team that maybe isn't necessarily depository, but also has a distributor retail team, you might be able to capture another purchase or maybe that future refinance. Yes, a 7% loan is more likely to refinance again, but you also run the risk of it running off, right? So I think the highest level of retention is like what, Freedom at like 87%. I mean, 84%, 82%, something like that. So, so there's still a chance of runoff if you get something at 7%. Then the macro environment brings in rates in the low 6s. Anyone can pick that off, not just the servicer. So all those servicers do win a lot. So it's a good comment that Sean made.
Great comment. I think there's another factor that comes into play, which is, what is your cost? Like, what did you acquire that MSR for, right? What multiple did you price in if you originated it, or did you acquire it at? Because that plays. I mean, I would love a 7% note rate, if I acquired it at like a 2.5 malt,
sure,
versus a
6 malt. I don't know that it adds a lot of value.
Yeah, there's a lot that goes into it. And KP, you bring up Freedom. I think Stan Middleman has been one of the smartest operators in the MSR space for decades now, and he's 100%. One that if you want to get an idea of what's, he's kind of like the Warren Buffett of MSRs, right? If you want to understand where the market's going, where it's likely to go, just follow Stan's trades, because he doesn't miss very often.
He peeks around corners. He's seeing around corners. It's the title of his book, and right. He's a beast. And he's got a great team around him, obviously. And I believe they're still the biggest government MSR portfolio that's out there. I know Lakeview, I think, is the biggest portfolio overall out there. I think Freedom has done a great job on government lending. We sell government loans to them. They do a great job. And what I'll say is, a year ago, they really paid up and bought into the conventional market too. And I thought that was pretty interesting. They obviously have a war chest, and I mean, MSR is a totally different game, and every servicer has different strategies at different times, mostly, based on, what they want to do with their money and how they want to make money. Some are public, some are banks where, it's like their 30th revenue stream. So, they're maybe not super aggressive. And then some of them are an independent mortgage banker, like a Freedom, where like, this is what they do. This is like, the portfolio is it, right? So it's interesting.
Company CMG is a big player and is a growing player in the MSR space. Yeah.
Oh yeah, they're huge. Yeah, and she's right at the top of the stack there. In the industry. So we miss her. Hopefully she'll
have a good time. But this what Sean put up is the difference in models and business models that folks have. We don't all have the same model. We may have some overlaps and some similarities and some ways and directional thinking, but different teams have different approaches that allows everybody to make money and serve different pieces of the market. And that's something I think, as a top producing originator, you have to know what your model is. That helps you find the right fit for the organization that you want to be at. It helps you grow in the market that you're in. It helps you decide where you want to be. Like, there's so many factors that come into play. And I don't know that to your point, there's not a right or wrong answer with, do you want that 3% coupon or do you want the 7? What's your model and how are you going to serve it? And are you going all in and doing what's necessary to make that model successful? You know, the old adage, just make a decision and then make that decision the right decision.
I'll just add, because I know we're at time, but you know, one of the things I say internally to some of our teams is, you know, we're built by originators for originators. These are my partners right here on here. This ChatGPT logo, one of our branch managers, President Cabinet Winners, he had a Snakes and Flames. He made a song about our PRMG. It's pretty cool. But when I'm talking, I do the closing comments at our orientation for new hires the second Tuesday of every month. And I say, we put the originator first. That means the originator in retail or the branch manager and the account executive in our TPO channels. And then other companies are built by the hedge fund for the hedge fund, built by the bank for the bank, built by technology for technology, built by the portfolio for the portfolio. Everyone else is just ancillary. And so, and again, I'm not trying to say our model's better. That's our path, to your point, Christy, that we've chosen. And I think every company has to decide like what they're about, what's their identity. And it's a good point you bring up.
Yeah, you can't be everything to everybody. That's for sure.
It's
Guys,
hard.
good combo. Enjoy the chairman's conference, and KP, we'll see you in Atlanta at the tail end of next week. And for all y'all, the rest of you, we'll see you right back on
What Brian's bonk Wi-Fi is trying to say is, y'all have a great weekend.
See you all.